The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
1 week ago, the Luna Guard Foundation had over 80,000 Bitcoins in their reserves, as well as other cryptocurrencies worth a total of about $4 billion at the time. Where did it go? Joining us now is Chen Arad, Chief Operating Officer at market surveillance and risk monitoring firm Solidus Labs. Hi, Chen. Thank you for joining us. So the reserves were supposed to help UST keep its peg. So the burning question on everyone's minds is, where's the Bitcoin now?
Thank you for having me, Christine. Great to be here, despite the circumstances. It's a natural stage for any new industry, new asset class to deal with challenges like this. And of course, the question is, how do we move forward and address this? I think that, looking at the big picture here, at the end of the day, a lot of crypto services essentially propose new ways to provide financial services that require less middlemen, replacing, various systems that exist in traditional finance with very sophisticated mechanisms that are code-based. And that's, in that sense, what we had here. You mentioned earlier, Christine, the vision for Terra and Luna and Anchor and many other services in that ecosystem was extremely compelling. Very smart people were thinking about this for a long time, including on creating funds to absorb unexpected occurrences like we had last week. But we do need to remember that in many of those services, it's still not battle tested, not stress tested. And in that sense, even though there was an attempt to allocate funds and even start transferring them into the Terra ecosystem, to essentially return the peg, it simply wasn't enough. Of course, it's also connected to the fact that all of this operates in a generally nascent ecosystem where, for example, a lot of those funds were in Bitcoin, which is still, at the end of the day, very volatile and just another factor that kind of added to the fact that it wasn't enough. At Solidus, we specialize in monitoring trade behavior, and work, of course, very closely with with partners on the on-chain analytics side. And there are indications the money have moved various places, but again, it's I think maybe one of the biggest conclusions that I have for the moment is that Terra specifically was in a lot of ways uncharted territory when it comes to risk monitoring. There are some of the risk monitoring capabilities were less advanced there than they were in other blockchains, where they've reached a pretty high level. And so it makes it harder to anticipate an alert on something like this when it happens. And I think something that everyone should remember, there's a lot of opportunity in those places. Anchor was an amazing opportunity for the average investor, but in part because there's a very high still risk in some of those cases. And we all have to evaluate that when we decide where to allocate our money.
Well, I think that was the problem. Anchor was very attractive for this 19.5% annual percentage yield, but it was ultimately unsustainable. And in terms of battle tested, Do Kwon had previously worked on a similar algorithmic stablecoin, Basis Cash, that ultimately failed. Now, he said that, and he called a Ponzi scheme, he said that Terra Luna would be different because of the different incentives, such as Anchor Protocol, but that ultimately ended up being the demise because the Anchor Protocol and the yields that it gave were unsustainable. And so they were supposed to be a decentralized algorithmic stablecoin, but in the end, they realized that, if there was a big market event, we're assuming that that's why they started gathering this massive reserve of cryptocurrencies to back up UST in case it started to depeg, which is pretty much what happened. Everyone wants to know, what happened to this huge stash of Bitcoin and other cryptocurrencies. Over the past couple of days, Elliptic released an analysis, and they said, a lot of the reserves, the Bitcoin reserves, went to Gemini. They also went to an account into Binance. But I guess, since you're a market surveillance firm, what happened from there? It just kind of went into a black box.
So again, I keep on thinking back to the May 10. The 2010 flash crash that happened in May that year. It happened in swaps markets because of a cross-asset arbitrage. At the time, Gary Gensler, who is today the chair of the SEC, was the chair of the CFTC, and he called for an investigation. And we talked, at the time, it was a few hours of trading that caused hundreds of billions in loss, and that is on a traditional market that has been tested over and over. But new tools were introduced that created some new risks and challenges. It took 3 months to collect that data, and ultimately it led to it led Gensler at the time to introduce a comprehensive surveillance program for swaps, exactly so that answers for the kind of questions you're asking could be given in real time, or at least closer to real time in the future. And in that sense, there's a lot of questions that are still being answered that are still being investigated, by our team and other teams like Elliptic, who are partners of ours, in order to understand exactly what happened. Again, we need to remember. Sorry, please go ahead.
Yeah, so I guess the bottom line is, were those Bitcoins actually used to shore up UST? Did they actually do their job, what people expected they would be used for, which is had the Bitcoin, it was a form of asset to back UST in some way. Did they actually do that, or did something happen to it that they don't know? Which was it?
So again, it's still going through investigation, and when risk monitoring is not, integrated or is still in early stages in a particular ecosystem, it naturally means that it's harder to say exactly what happened very quickly. There's no question that this is a very big incident, and we've heard the two guests that spoke right before me. Lennox really emphasized the need to raise the bar, raise the standards for risk monitoring, so that it's, first of all, possible to alert in advance when something like this happens. And I can say we're working very closely with a lot of platforms, blockchains, and also on the buy side with investors in order to provide this sort of alerting. But the other piece is, of course, that when something goes wrong, and something will go wrong, definitely in a new ecosystem that's still evolving, it still happens in traditional finance, right? So something will always go wrong. The ability to very quickly understand what exactly happened so that it can be rectified, and if there's people can be held accountable if those funds were not used properly, depends on the ability to understand risk, and the potential of decentralized finance at the end of the day depends also on the ability to mitigate risks and provide those explanations to regulators, to the public, to investors. In this case, again, it's still being investigated. To your question, it appears that yes, there were attempts to use those funds, but I can't speak with 100% clarity yet, as again, this is still being investigated, will continue to be investigated over in the near future.
Yeah. Even if those Bitcoins were used to protect UST and fail, the fact that it failed, and this is the question we've asked the other guests today, does that affect the long-term prospects of the crypto markets in general, in terms of integrity, and also in terms of market participants' willingness to get back in the game, now that they've seen something this big collapse so spectacularly and take out so many people's fortunes with it?
I think there's no question that this impacts how people perceive our industry. And I think it's also important to keep in mind that, it isn't the first, it isn't the first incident in a while where there's a really big incident that causes a lot of people to lose their money. I mean, we can think back, a couple of months back and think of a few hacking incidents, wormhole access, etc. All these things at the end of the day impact how people perceive our industry. Now, it's natural that in a new industry, there are new risks. The question is, how are we working as an industry to continually deal with these issues in order to prevent them? I mean, I think that stablecoins specifically are critical, needless to say, in order to attract more people to crypto, have a place where you can custody crypto while you're switching between assets, etc. That is not very volatile. The fact that this very, very promising, very compelling idea of an algorithmic stablecoin, and the leading one really, collapsed in a lot of ways, requires kind of going back to the drawing table and coming back to the public and obviously to regulators to explain, how do we prevent this? How do we create something like this that is actually sustainable? Obviously, you have stable coins that, in a lot of, really innovate financially, but also rely on, the tried and tested idea of, real world collateral, like USD or others. But, this really shows in a lot of ways that, the algorithmic solutions here still need a lot of stress testing. But, we need to remember that this is an opportunity to, we're the new kid on the block because of issues like this. Crypto is. There are a lot of issues in traditional finance as well. We're trying to solve them. We just need to be very, very honest and careful in how we do it. And one of the most important keys to that is mitigating the new risks. Otherwise, all of the potential will not be fulfilled because, we will lose the faith of the public over time, and definitely that of regulators. And I think that's the most important message that comes out, not just of my interview, but the other interview is right before me. That we have a lot of work. We're committed to doing this as an industry.